Hey, good afternoon, everybody. Welcome to today's event. This is our Q3 earnings sneak preview. You got John Hopkins here, Tom Bowley going to jump in just a minute. If you happen to be new to EarningsBeats, want to welcome you to today's event. I think you picked a good one to come to. They're all good. And of course, those of you who've been members for any length of time, thanks so much for your continued support. Really appreciate it. Today's event, like all of our webinars, will be recorded. If for some reason you're unable to stick around for the entire event, no problem. We'll make sure you get a copy of the recording probably sometime tonight. This is a very, very busy period for the team at EarningsBeats. We've got, of course, tonight's event. And then tomorrow night, very timely, our Max Pain webinar, where Tom will discuss the major indexes and then different individual stocks that may make a move between now and expiration Friday. If any of you saw Tom's article, one of his articles in ChartWatchers this weekend, headline basically was get ready for a big rally because things have gotten too pessimistic. So he'll get into the puts and calls tomorrow night and what that might mean in market direction for a little bit. Wednesday, we've got by the way, tonight's open to the public. Tomorrow's members only, as is Wednesday when Tom will reveal the model ETF portfolio where he picks the ETFs that will be a part of the portfolio for the next 3 months. Also a members only event. Then next Monday, we've got the Q3 earnings. So tonight's the preview of what the full bore Q3 earnings webinar is going to be about. So that's one that also will be members only. So it's a great time. If you're not a subscribing member, you can take out a free trial for 30 days. You get access to 3 member-only events, which is pretty rare to get that kind of access. So you should put some, if you're ever thinking about giving us a try, this would be a tremendous time to do it because you get all of these events that are coming up over the next few days. Just a huge amount of great information. Now, I'm going to bring Tom in here in just a second, but I think this particular earnings season warrants a little bit more of attention for some of the reasons, we've thought about. First of all, of course, you got the Fed on its, rate tightening binge right now. In addition to that, you've got, some supply chain issues. You may have companies warning. We've already seen a couple of warnings. So a lot of things to consider this time around that Tom's going to jump into. Anyway, so lots going on, and Tom's back on the scene. I imagine you've caught your breath by now after coming back from the West Coast.
Yeah, I'm getting back into the routine. It's taken a little while trying to catch up, but it was a good trip, no doubt about that.
Yeah, I already got a member who said he wanted to welcome you back. Good to have you back on the scene here.
Yeah, it's good to be back. It was nice getting out there. Hadn't been out to Seattle or that area in 4 years. So
yeah,
really good to get out there, but it's always nice to get back home.
Okay. Well, you got a lot going on this week, and I'm going to be taking a lot of notes myself, but I know there's a lot to cover. So I'm going to step out of the way and I'll let you take it away.
All right, sounds good. Tonight's just going to be looking at charts. Not really a whole lot to talk about. I'm going to take a look at some, just a few charts of companies that have already reported, and then take a look at some upcoming earnings reports this week. So it's really focused on the near term. There haven't been a whole lot of earnings out so far for earnings season. There's not a whole lot out this week. I think for the week, over $1 billion market cap. I think it's like 150 companies, which may seem like a lot, But by the time we get into the middle of earnings season, it's going to be more like 1,500 companies reporting in a week. That'll be in the next couple of weeks. So we're just starting, just getting going. And, I think the bar is set pretty low at this point. I don't think too many folks are expecting blowout earnings given the way the stock market's been behaving for the past, well, really all year. But after a nice rally in July and August, we turned around, went all the way back down to the June lows, actually went just a little bit beneath them. And currently we're sitting almost right where we were at the June low. And so I don't think there's a lot of expectation. And already we're seeing companies that are getting rewarded pretty nicely. Most of the companies in the banking area that we've seen some pretty good results and some nice reactions. But first week or so is really inundated with financial reports. They tend to have very sophisticated accounting departments. They do a lot, the Federal Reserve comes in just about any time, when we're looking at the banks. And so the banks have to be able to get their financials together very, very quickly. So that's why they're among the first companies to report each quarter. And they just give us a little bit of a flavor. I'm not looking for banks to lead the market to the upside, but we want banks to remain fairly healthy. And when I say fairly healthy, I'm just talking about on a relative basis, going along with the S&P 500. If the S&P can start moving higher, would be great. We don't need to see leadership coming out of banking, but you don't want to see them lagging badly either, because that's generally not a good sign for the economy. So anyhow, we're going to go through and just look at a lot of charts tonight. And I'm going to jump in here and get this thing started right now. So bear with me one second. All right, first thing I have up here is the S&P 500. And you can see this morning we had a gap up. This is a 5-day, 10-minute chart. So this was the opening gap this morning. We moved up and then literally just went sideways all day long. If we look at the NASDAQ, we're going to see fairly similar action, gapping up. We did see maybe a little bit more of a push to the upside, but still, once we got through the first, 10 minutes this morning, we were in a fairly narrow range going sideways. I think the market was poised to make more of a move up today. But if you look at the 10-year Treasury yield, the 10-year Treasury yield had gapped down. We had the October Empire State Manufacturing number came out this morning, and it was weaker than expected. I think the market really liked that. The bond market, you saw a lot of buying in the bond market at the open, sending the yields down. So those lower yields, I think, were really good for equity. So we saw the gap up. But look what happened with the yield throughout the day. The yield climbed and went all the way back up, turned positive at the close, back to 401, a little bit over 4.01%. So I think that really put a lid on equity prices today, just the fact that the yield kept going up. If we can get a little bit more sustainable move to the downside in the yield, I think we're going to see a much bigger rally in equities in the short term. But obviously that's a big if. We've been trending higher in the yield now for quite some time. And if the yield keeps going up, that's going to be quite the headwind for equities to try to have to negotiate to go higher, and especially the NASDAQ on a relative basis. NASDAQ relative to the S&P 500 broke beneath the June low, which is significant because that's one of my sustainability ratios that I like to watch. And so if we pull that up and I just look at like QQQ relative to the spider, and this is the June low, or May low, I meant, not June, but there's your May low. And you can see we actually went down beneath that at the open on Thursday of last week. But what I normally like to do is just look at this on a line chart, because I think there's too much noise with all of the candlesticks. But you can see right here, this low went just below 0.73. And here back in May, we were a little above 0.73. Now I look at a lot of sustainability ratios, and this is just one. And this is the only one at this point that's turned back down and looks like this. The XLY, XLP was not looking very good, but it turned back up pretty nicely today. So you can see it's still well above. And this simply says that Wall Street is moving away from discretionary stocks all the way through May. While the market was going down, Wall Street wanted nothing to do with consumer discretionary, and that makes perfect sense in an inflationary environment or in an environment where you're expecting the economy to weaken. Consumer discretionary stocks should not do well in that environment. But what's been interesting is inflation keeps going higher and interest rates keep going higher. Look at the relative strength turn and change. And that was what triggered the top, or one of the things that triggered the top when the S&P set a new high in January. And look at this ratio rolling over. So we weren't getting the leadership we wanted at the top. That was one of the reasons why we went lower. And now we're getting the opposite. We're seeing actually money rotating back towards consumer discretionary, even though the S&P 500 is much lower than it was back in May. If I go back and pull up that S&P 500 chart, I mean, look where we were in May. We were at 3,900. We just recently went down under 3,500. So the S&P keeps going lower, but Wall Street firms are moving more and more on a relative basis into aggressive areas. And I think that's a bottoming signal. We're going to find out. Anyway, I just wanted to update before we went into all of this, because I'm sure there are questions. A lot of folks wondering, I get questioned a lot of times, because I keep calling this a cyclical bear market. I get asked lots, what would change my mind? What would make me think that this is a secular bear market, which is a long-term bear market, which could have much, much, much further downside. And what I would say, number one, is we've had 3 of those bear markets since 1950. Every time we move down, a lot of times, even if we get in a correction, short-term correction, everybody starts panicking and thinking, oh, this is the next depression. And I mean, it's just normal. 6 months ago, yeah, the news has gotten worse, but it's not a whole lot worse. Maybe interest rates are a lot higher. I'll give you that. But in terms of the inflation rate, I mean, back in March, the inflation rate now is just slightly above where it was in March. And we actually went down a little bit after March for a couple of months, few months. So you could argue that, we're still seeing, jobs reports that are positive. I mean, the news isn't that much different, yet attitudes and the sentiment has turned so bearish. And it's just the constant beating from the S&P 500 going lower and the media just constantly talking about all the bad news and the awful stuff that's going on. And it's hard, psychologically to keep the same focus now that you had back 6 or 8 months ago. And we needed this. I said that at the beginning of the year. We needed this selling. We needed a cyclical bear market. We needed sentiment to turn. We were way too bullish, way too complacent. And so all of that's changed as we head into this quarter. So, for me to think more bearishly long-term, the first thing I would say is if you go back and you look at a long-term monthly chart, and I'm going to go back a long way here. This is a monthly chart, and I'm going to go back 100 years. That's a pretty long way. Look at the secular bear markets, 2000 to 2012, right in here. Notice that selling, that's a long time to not set an all-time high. Look back in the 70s and into the early 80s. See how we went sideways and we went 10 years without setting a new all-time high. Here we went 13 years without setting an all-time high. Go back to the 1930s. We set this high in 1929, and we didn't get a new high until 1955. When we start talking secular bear markets, we're talking long-term, not seeing a new high for a long, long time. We're not talking about next year, the year after, going back to all-time highs. So that's a pretty bold statement. You can see over 100 years, it's happened really 3 times. I just see too many positives. We still have interest rates as fast as they're moving up. They're still at 4%, historically an incredibly low rate. So I think there are fundamental reasons why I don't believe this is a secular bull market, but technically the monthly PPO has to go negative. Look at this secular bear market. Not only go negative, it was really weak. You have to stay in a downtrend for a very lengthy period of time to get that monthly PPO to go negative. We did that back in 2002. We did it in 2008, 2009. And so you can see that the monthly PPOs followed that to the downside. Look at 74, back in the early 70s. I mean, these are signs that you probably have something more than just a cyclical bear market. The 1960s, I mean, we went just a little bit below and then turned back up. And it wasn't really until the early 70s that we saw these bigger dips in the monthly PPO. But if you look at the 80s and 90s, we had the 87 crash, we had the 90 Persian Gulf War, spiking oil prices, recession, all kinds of bad things going on. Inflation was moving up. But notice the monthly PPO, it got close to the zero line, never went beneath it. 1994, 95 was kind of like a sideways period. You can see the monthly PPO get close to that center line, then back up again. Anyway, all of these things are signs I look at. Right now, we're still above that. The other thing, if you're looking at the RSI, in a secular bear market, the monthly RSI goes below 40. In secular bull markets, it doesn't. RSI 40 on a monthly chart tends to hold. It did it throughout the 80s and 90s. It did it throughout the 50s, 60s. We did have a couple of these periods, just like the PPO. Got a couple little head fakes there. And we went just slightly below RSI 40 or just very briefly and then turned right back up. But notice when we went back up over 60 into the 70s. And that usually is a pretty good indication when you're up here with monthly RSIs that you're still in a secular bull market. Look at the 1980s and 90s. Look at all the readings up here in the 70s and 80s, monthly RSI. How many did we go below 40? 0. From 2000 to 2012, 13, we had one time right before the next bear market began in 2007. We went up above the RSI 70 level. But for the most part, we were down below RSI 60, and multiple times we went down below RSI 30. That is typically your secular bear market. So right now, and if I hadn't already said back at the beginning of the year, I mean, I talked about this at the beginning of the year, that this is what I thought we were going to be looking at. I really thought it was going to be 3 to 6 months rather than 6 to 9. Excuse me. And I also thought that we would see about a 25% pullback, that's more than pullback, bear market. But back on January 8th, I said that worst case for me was 3,500 to 3,800 on the S&P 500. That's where I thought we would go, potentially. Worst case, we got down to 3,491 on last Thursday. So is that it? I don't know, but we've certainly hit that target. We've hit the sentiment reset target that I was looking for. I'm giving this market the benefit of the doubt right now. Anyway, that's all I have to talk about with the market. Let's actually look at some of these earnings reports and some of the charts. So I'm going to start off. Let's go back to last week. And there were a couple of really good reports that came out. One was Pepsi. Pepsi reported much better than expected earnings. And you can see Pepsi, look at the AD line, very strong. Look at the relative strength versus soft drinks. This was when earnings came out. This was all prior to earnings. This is what I look for going into earnings. I mean, if a company's got really strong relative strength and then they beat, these are stocks that I would be, keeping on a watch list. These are stocks that are going to go on our strong earnings chart list, so long as they beat top and bottom line estimates. Look at the reaction with the earnings. So Wall Street was already in based on this relative strength, or at least Wall Street is rotating toward this stock versus other stocks in the soft drink area. I think I did a EarningsBeats Digest article not too long ago, where I looked at Pepsi relative to Coke. And look at Pepsi outperforming Coke over the last few months. So Pepsi came out with a really good report and has gone up. I'm not so sure Coke's going to do the same. We'll find out. But this is an interesting chart to watch. Sometimes I like to pair these charts of companies that are in the same industry group that obviously are competitors, and just see which one is the leader, which one's the laggard. Then wait and see what comes up with earnings. I don't know that Coke is going to miss its earnings estimate. I just would feel better about holding Pepsi into earnings than I would Coke, just based on that alone. And that's really the whole idea behind these earnings events that we do, is I use relative strength significantly in my analysis heading into earnings. If you're trying to decide, do I hold a stock into earnings? Do I not hold? That's probably the biggest indicator for me as to whether or not I would hold or not. Stocks can still do anything. You could have a stock that looks incredibly strong on a relative basis. They come out with good numbers and you can still get a sell-off because it's a buy on rumor, sell on news kind of thing, which I think most of us are pretty familiar with. But if I've got a stock that's performing really well and they come out with great numbers and they gap down, I'm usually using that weakness to consider building a position. Whereas if a stock's been going down and has been performing poorly on a relative basis and they come out with bad news and they gap up, I have no interest in that stock whatsoever. I mean, it's got to show me some real strength for a period of time. In fact, if I was considering shorting, that's one of the things I would be looking for. A bad report, so it's been a sell on rumor, buy on news, a lot of times go up to the 20-day, 50-day, and then roll back over again. So those are some of the things I would look at. Another company that reported last week that had a great, I thought a pretty good report was UNH, United Health. And let me see that they were expected to earn 545. They earned 579. So an easy beat. They surprised by more than 6% to the upside. And you can see the stock with its earnings, nice gap up. And look down here below. Look at United Health relative to the healthcare providers group. Look at this beautiful relative strength. And I don't know if you saw my article John was referring to. Well, that's not working. I don't know why it's not letting me go into the articles. Anyway, in the articles, one of the things that I talked about was that healthcare providers, I mentioned how healthcare in general, the sector, had broken out to a new all-time high, and I started to break down that group in my article. And healthcare providers and biotech were the two strongest industry groups within healthcare. And so when I see UNH, which is a healthcare provider, reporting, and it's one of the better stocks within one of the strongest, look at healthcare providers relative to the S&P 500. So you can look and see healthcare providers right here going down the last couple of months. This is on an absolute basis, but on a relative basis, money's rotating into that group. That's where Wall Street is looking and finding safety. And so when you hold a stock like United Health into earnings, I'm going to feel a little bit more confident about that. Anytime you hold a stock into earnings, you're rolling the dice. You might as well be in Vegas. But I do think that you get better odds if you're in stocks where you've got relative strength. That's the whole idea behind what we're doing here in this webinar, is just talking about relative strength and how you get, perhaps some decent opportunities if, in fact, you like to hold stocks into earnings. It's not one of my favorite things to do. If I'm going to do it, usually I do it with a small number of shares. I would certainly not have a full position, just because, I mean, you can be down 10% at the open, 20% at the open the next day, depending on how volatile the issues are that you're trading. But let's look at another company. This is a company that reported. This is Walgreens Boots Alliance. Now look at this chart going down. Look at the AD line going down. Drug retailers going down. WBA relative to drug retailers going down. The drug retailers overall not doing bad versus the S&P, but this is one of the worst stocks in the group. And so after the earnings came out, you can see the stock actually rallied a little bit, but after it went up for one day, it's come back down last 2 days, even today, with a nice move up in the market, we saw Walgreens Boots Alliance come down. So this is a stock personally I would stay away from. I'm just not a fan of, a company that has reported and has been and was downtrending prior to the report. Now, when they came out with their earnings, they actually beat 80 cents versus 78 cents. But after a little bit of a rally, you can see the market not overly excited about the stock right now, even though it's in a good group. Drug retailers are inside that consumer staples area, which hasn't been a bad group on a relative basis because it's defensive. And with the market getting hit pretty hard in 2022, that's been an area of safety within the market. Relative safety. Again, if you look at the group's gone down. It was trading down near a 52-week low. So it's not like drug retailers haven't gone down. It's just that on a relative basis, they've held up better than the S&P 500. All right, so those were some of the companies that reported. Of course, JP Morgan reported. That was on Friday to kind of kick things off, or at least what I consider kicking things off. JP Morgan was expected to come in with earnings at 296. They came in at 312. And look at the reaction in the market, this huge move back to the upside. So this was Thursday when we had the big rally in the market. And then Friday morning, when we got the report from JP Morgan, you could see we gapped up, traded up intraday, came back down, failed to hold the 50, and then did it again today. Big gap up. Didn't really trade very much higher after the gap. And look at the AD line. The AD line was starting to strengthen back in July and August. Now starting to roll over again a little bit. I'm not sure. This is a mixed picture. Banks, you can see, have been going down relative to the S&P 500. They didn't look very good, but they have bounced here over the last few days to a week. And you can see now we're actually trading at the highest relative level on banks that we've seen since back in March. JP Morgan has popped up also looking for its highest relative strength level since back in late February, early March. So we're starting to see some strengthening in JP Morgan, but there are enough mixed signals where I personally would probably still stay away. I'd look for other stocks within the banking area. All right. Now let's take a look at maybe one other stock that reported. This is Fastenal, and this is in the industrial suppliers group. And you can see Fastenal was going down. It gapped down with its earnings. Look at the industrial suppliers going down near 52-week low. Look at Fastenal relative to the industrial suppliers down near its 52-week low. The group, again, not bad. Industrials actually have been pretty good overall as a group. And this industry group, industrial suppliers, have not been bad. But you have one of the weakest stocks within the group. That's the beauty of relative strength. Do you have a leader? Do you have a laggard? This matters. There are going to be a lot of stocks in this space that have their relative strength lines going up. Those are stocks where Wall Street is rotating into. This is a stock that Wall Street has been rotating out of. We don't have the luxury of calling up management of Fastenal and saying, hey, let's talk about the numbers. Let's talk about your competition. Let's talk about, what you see in the quarter ahead or the next couple quarters. They're not going to pick up the phone if we call. But Wall Street firms, Goldman Sachs of the world, they have a direct line to these companies. They do a lot of underwriting for them. Trust me, when they call, they pick up the phone. And so if we follow the charts, we get a better sense of what Wall Street is doing after meeting with these companies. That's the importance and the beauty of relative strength. Anyhow, so that's what's gone on so far. So with that background, I'm going to go through and we're going to pull up some charts. Probably only be here another 15 minutes or so. I really don't want to spend a lot of time on this. And we're going to do this again in a week. So we'll have another webinar next week where we will take a look at upcoming earnings going out further. And it'll be, I think, pretty interesting. All right, so what we've done and what we continue to do, what we've been doing, for those of you that are new to EarningsBeats, is we set up an upcoming earnings chart list for every day during the heat of earnings season. So probably from now until probably toward the end of November, we will be providing every day an upcoming earnings chart list. And so for today, for instance, now this was for just companies that were reporting this morning. So we do 5 of these each week. So we do one as of Monday morning, companies that report Monday morning. And then the next one we do will be Monday afternoon and Tuesday morning. The reason we do it like that is because both Monday afternoon and Tuesday morning, we are getting new information since the last market close. So all of these companies, the ones that report after the close today and before the open tomorrow, all of them will open up tomorrow with new information. So we want to know, are they gapping up? Are they gapping down? So if you take a look at, for instance, this chart list, now there's only 3 companies that reported this morning that had market caps over $1 billion. And that's what we use as our threshold. And if we pull this up, what you can do is once you look at this list, or if you have a stock charts account, extra or above, so you need extra or pro membership at stock charts. But if you have that, we provide you a link and password. You can download all this information we put together, the research, we do it, and you can download it. And then you can view in summary form all the stocks at one time. So literally at 9:31 or 9:32 in the morning, right after the morning opening bell, you can pull up and see what the reactions are. So today, Bank of America went up 6%, Bank of New York Mellon Corp up 5%, Charles Schwab went down 2.25%. So in one place, you have the reaction of all the companies that have reported. Now, this is nice, 3 companies, but it's pretty easy to pull up 3 companies. But when you get toward later in the week, we start to get a little bit more, like I think it's Wednesday afternoon into Thursday morning, which is 10:19 after the market closes to 10:20. Now, if we hit edit, you will see that we have 78 companies that will be reporting. Not so easy to pull up 78 charts in the morning when the opening bell rings. 3, yeah, you can do that pretty quick. 78, not so much. And wait until we have 500 reporting in a day. That'll be right in the middle, the heart of earnings season. These chart lists are powerful to have when you start getting into a lot of earnings reports coming out, so that you can quickly identify companies that are moving up or moving down after their earnings report. So here, now, of course, these haven't reported yet, but if I did this, if I pull this up Thursday morning at 9:32, I can quickly look at the best performing stocks that just reported, so I can get the reactions, and I can flip to the other side and look to see what didn't react very well to their earnings report. A lot of times when you get gap ups after earnings, everybody's buying, market makers are on the other side. Sometimes, if you're an aggressive day trader, you could jump in on the short side after stock gaps up and make sure you keep a stop in playing. You don't want that thing to get too far away from you. But a lot of times they'll go back toward the gap. And so you can short, take advantage of that. Or on gap downs, big gap downs, everybody's selling, market makers are buying. They have to provide liquidity. So a lot of times in the short term, that's the reason why you get gap fills. The biggest reason is market makers are on the other sides of these trades after you get gap ups and gap downs. And just in case you don't know, market makers over time do not lose money. They'll lose on individual trades. Don't think they're, bulletproof. Market makers lose on trades all the time, but over time, yeah, they're not going to lose money. They're going to make a lot of money. So if you're not already a member, or you're not using this part of our service, if you're not a trader, a short-term trader, then maybe you don't care. But if you trade, this is really powerful information. And this is something that we give to both EarningsBeats Digest subscribers, our free subscribers, and our paid subscribers. But I think it's really cool. feature that we've developed over at Stock Charts on their platform. And it takes a lot of work. Matt Townsend here at EarningsBeats actually helps me. He puts together these lists. He spends a lot of time on it. And I mean, again, you can see this is just one chart list for a day that's early in earnings season. It really starts, it takes a lot of time to put these together when you get into the middle of earnings season. I know because I've done it. It takes a lot of time. All right. So how about, so what might be a strategy when you get these chart lists in terms of trying to figure out relative strength? Because still you have to go in this case, there's 78 charts. I got to look at 78 charts to find out which ones are strong and which ones are weak, right? Well, no, you don't have to do that, because once you get this thing set up in summary form, see this columns area right here? Just go in here and click on sector, industry, and scooter score. And now all of a sudden, you've got that showing up on the summary feature. And now I can sort by scooter. And I can find stocks that have very high scooter ranks. Now, if you're not familiar with scooters, you should go over to Stock Charts Chart School. And you can read all about the scooters, but it's Stock Charts Technical Rank. So it's just an acronym, Stock Charts Technical Rank, SCTR, developed by John Murphy. The limitation here on the scooter is that basically you're only looking at relative strength over the last 5 months or so. So if you're looking and you want to know what's been strong over the last, year, 5 years, 10 years, scooters are worthless. But if you want to know what's been going on heading into an earnings report for the last few months, the scooter scores are awesome. They give you exactly what you're looking for. So I just took these 78 stocks, which we prepare into a chart list, and have it set up with the scooter, the summary form. And you can quickly identify what these are some of the best charts. So let's look at that GPC chart. Look at the price action going up. This isn't rocket science. AD line going up. Now, auto parts not so strong. And you can see auto parts kind of flat versus the S&P for the last several months. But GPC relative to the auto parts and relative to the S&P 500, very, very strong. And they will be reporting. I'm not sure if it's Wednesday after the bell or Thursday before the open, but this is a stock that I would expect to have a good report out of. Does it mean the stock goes higher? No. Is it a guarantee that we beat on revenues and earnings? No. Sometimes management misleads Wall Street. I mean, I've seen that plenty of times over the years. Wall Street goes in, talks to management. I'm assuming everything sounds hunky-dory. They come out, they're buying the stock, and then management drops a bomb on earnings. Trust me, that doesn't go over well with Wall Street. It takes a while to earn back their trust after something like that. So whenever I see a company that's been trading really well on a relative basis, and they lay a bomb, they miss, or they warn going forward, and the stock takes a massive drop, it's a long time before I get involved in a stock like that again. Netflix is a good example. After some of the huge disappointments they've come up with in the last year and a half. And by the way, Netflix is reporting tomorrow. We'll look at that chart in just a minute. So this is how you can find, using the tools that we provide you. We do all the work. All you do, pull up the chart list. First you got to download the chart list. We give you a password. You hit a link, it comes up, asks you for a password, you give the password, and then you can store it right into your Stock Charts account. If you want to try Stock Charts and you haven't tried it before, you get a 30-day free trial at Stock Charts. You get a 30-day free trial with us if you haven't tried us, our service. So heading into earnings season is a good time to try both, to really test out the platform and get the most out of what we do. All right, so let's take a look. Let's go into that Tuesday, I think it's Tuesday evening and Wednesday morning. Yeah, there's Netflix. So I don't know if you noticed today, but Netflix, 245, it got up to 249.92. I mentioned in our daily market report that I sent out to members. I think that's where I mentioned it. I mentioned so many things, or maybe I was thinking it. Anyway, Netflix has not closed above 250 since all the way back on April 19th. And they came out with their earnings. This is one of the many disappointments you can see here. Look at this disappointment over here. I mean, Netflix less than a year ago was over 700. It went, well, it's still only 245. Now, a lot of that is Netflix's fault because they just didn't report very good numbers. And a lot of it is just due to the overall market environment, rates going up, higher inflation. These are all things that eat into earnings of growth companies like Netflix. And that always eats into the valuations. But Netflix is starting to turn up. AD line's gotten better. Wouldn't say it's great. Here it went up with this big volume, but really last few months, it's just kind of been going sideways. While internet stocks have been going down, notice Netflix is actually starting to show a little relative strength versus this very weak group. You can see internet relative to the S&P has just been horrible and still really no signs of life, not much. So I'm not overly excited about Netflix, but at least it is trending in the right direction right now for the last few months on a relative basis. But again, relative to some really bad numbers in the space. So that's Netflix. Let's see. I'll give you a couple more and then we'll wrap this thing up. Intuitive Surgical. This is not in the biotech or the healthcare providers group, but it is in healthcare. This is a medical equipment company. But look at the relative weakness in ISRG. And the overall group has been not so great. It's come back up a little bit recently, but ISRG is still showing no strength whatsoever relative to its peers. So going into its earnings, which I think are going to be out tomorrow after the closing bell, I'm not feeling very good about Intuitive Surgical. Wall Street doesn't like it, so I don't like it. And people ask me all the time, what do you mean when you say Wall Street doesn't like it? What's Wall Street? I'm just talking about the big Wall Street firms, Goldman Sachs, you know, and the like, Merrill Lynch, all the big names. You know, these companies have just loads of MBAs on staff. They're brilliant people. I would much rather look to see where they're putting their money than to listen to some CNBC host telling us what's going on in the market. I mean, if that just doesn't make common sense, I don't know what does. Wall Street might say something on CNBC, but they can't hide their agenda on the charts. They're either buying or they're selling. It's really easy. Stocks are either in a relative uptrend or they're in a relative downtrend, or they're flat and showing us nothing. But it's really hard to misinterpret the chart. I don't trust these Wall Street firms when they get on CNBC. You know, they've got, you know, Goldman Sachs of the world. They've got portfolio managers that are managing billions and billions and billions and billions of dollars. So they've got that one side of the firm. They've got analysts that are going on to CNBC, you know, talking up or down stocks. They're raising price targets, lowering price targets, blah, blah, blah. You think they're going to raise a price target and give it to us and then go back to their firm and start buying that stock? I mean, if you think that's the way the market works, I've got a bridge I want to sell you. You know, they're buying before they're sending their analysts out onto CNBC. I can promise they've been making purchases before that happens. And so they're buying, and then they're going on to CNBC and telling you to buy. And then when you buy, guess what's happening? Their market maker units are selling. What a great deal for them. I mean, who set this system up? I can buy, I can then tell you to buy, and then when you buy, I can sell my shares. Wow, that's great. I mean, I doubt there's any conflict of interest there, right? I believe, and I've always believed, market making should be an independent business, should have no ties whatsoever to analysts making calls and to portfolio managers buying stocks. I mean, they, all right, that's another tangent. I don't want to get out on that rant. The good news is we can follow the charts and get a really good sense of what's going on. We never really used to be able to do that. And if we did, and I'm talking back 30, 40 years ago, but even if we did, the costs of trading were so ridiculously high. I remember buying stocks and having to pay $150 commission to get in and out. And I didn't really have much money back then. So folks now, I mean, we've got so many folks in the market now that may only have $100 or $200 that they're investing. If you did that back in the 1980s, the commission, you would be out, you'd be zero. So, there are definitely a lot of advantages to trading nowadays. We get so much more information, but you just have to figure out what you can trust, what information you can trust and what information you can't. Social media, it's the devil. There's so much information out there. You have no idea what's right, what's wrong. I know when I look at the chart, what I'm looking at. I'm looking at where the money's going. That's why, again, we do this and why I think it's so important to look at technically what's going on with stocks. I hear people say, well, the PE ratio. Listen, if Wall Street's buying it, I don't care if the PE ratio is 60, 20, 10, negative, 200. I don't care. If it's a relative strength stock and it's got momentum to the upside, I'm a momentum trader. I'm going to be all over that stock. Now, those are the types of stocks I want to trade. And again, you're talking about these firms that have MBAs on staff. They know what they're buying. You might think it's expensive, but they don't. I'm jumping on their bandwagon. All right. Just looking to see. Let me pull up, see what other stocks we have here. Here's a trucking company, JB Hunt. They're going to be reporting tomorrow, or maybe it's Wednesday morning. But here's the trucking group, which has been down. This is one of those that going back and forth, up, down, up, down, up, down, up, down, up, not really showing us anything in terms of leadership or, relative weakness. It's just not showing us anything. So normally I would just pass on a stock like this. There's way too many stocks out there to focus on a stock that is directionless on a relative basis. It's just telling me that Wall Street, there's a lot of indecision. You probably have some firms like it, some firms don't, and it's just balancing out. There's no real relative strength there. Let's go and look. That's not what I wanted to do. Let's look and see if there was another. Okay, we got Johnson & Johnson. Let's look at Johnson & Johnson. Oh, by the way, we do have these numbered. I forgot to mention this. So do you see the first four here starting with 0, 0, 0, 0, 1, 0, 0, 0, 2, and then the next one starts 1001, 1002. If you have it sorted in name order, or if you pull this up in edit function, it'll be showing in name order, and it's going to do the numbers first. So it looks at the numbers sequentially. The ones that start with 0 are going to be the ones that report after the closing bell. The ones that start with 1 are going to be the ones that report before the closing bell. So if you get this list, you're not sure when a company's reporting, that'll at least give you an idea based on what we've picked up from Zacks. So that's where we get our information. So we're only going to be as reliable as Zacks. And I think Zacks is a pretty reliable site. But anyway, I wanted to point that out so you know what the numbers mean. Now, after the numbers 1, 2, 3, like 1001, 1002, 1003, these are in market cap order. So the ones 1001 or 0001, these are going to be the largest market cap companies that report in those respective days and time frames. So we could look at J&J and then maybe LMT and Goldman Sachs, and then we'll wrap this thing up. So Johnson & Johnson been going down, AD line just kind of going flat. Pharmaceuticals, yeah, they were kind of going down, but now they're starting to turn up. J&J showing really nothing. I mean, I just look over the last year and it's just a market performer. When I say market performer, it's a performer or a stock that's performing relatively equal with the pharma group. It's not a leader, not a laggard. Now, it's actually been performing pretty well versus the S&P because pharmas are a defensive area. And for the most part, pharmas have been going up versus the S&P. So J&J is literally just being picked up and pulled along with the industry group. It's not showing any relative strength of its own. It's just that the group's been strong and it's kind of going along for the ride. That's the story that J&J tells me when I look at this chart, for 20 seconds. Lockheed Martin, its price going sideways. AD line actually going up a little bit while the price action goes down. That's a little bit of a positive. Defense stocks going sideways, but when you go down here at the bottom, that's not a bad thing because the S&P is not going sideways. The S&P keeps going lower. So defense stocks here is a winning group. This is a group that has been pretty strong. Lockheed Martin was a leader until the end of May. Since then, it's been going down relative to its peers, but it's still going up and just recently set a 52-week high versus the S&P 500. So again, the story here for me, Lockheed Martin, probably not one of the best defense stocks right now going into earnings, but the group is so strong that it's still been able to outperform the S&P 500. Would I be thinking about buying it heading into earnings? No, I don't think this is one of the better stocks, so I'm not interested. Last stock we'll go over here, Goldman Sachs. Obviously been trending lower. We had the 1 month, July to August, mid-July, mid-August, where we had to move up, but otherwise going down. AD line, though, looks pretty good to me. Relative strength. We bottomed all the way back here in March, April timeframe. We were strong for a while, started to pull back a little bit. Now we're strengthening again. This isn't bad. It's in a group that's been fairly strong over the last 3 or 4 months. Remember, that's where we bottomed. This is where, May, the S&P hit a bottom, and then we went lower in June. That's where I actually called the bottom. I think that the S&P was 30. I think the low was 36.36, and the low close was 36.66. And that's pretty close to where the S&P is right now. But look at the relative strength since then of investment services. Wall Street's been rotating into investment services. You don't see that by looking at the S&P 500. You probably don't hear that on CNBC. Maybe once in a while somebody will mention it, but this isn't something that is probably getting a whole lot of attention in the media. But under the surface, this is an important thing to realize, that money has been rotating into investment services. I expect we're going to get some pretty good reports in investment services. And if Goldman Sachs reports good numbers and pulls back maybe to the support level at 290, or maybe they report good numbers and gap up to the 50-day, maybe wait until they pull back and hit gap support. But if they report good numbers and they're already showing leadership, this is the type of company that I'm going to want to have on a watch list. Hence the strong earnings chart list that we keep at EarningsBeats. So we try to tie all this stuff together. And we'll see, how the earnings come out and how all these companies respond. But anyway, that's essentially what I wanted to go over, John, just to kind of highlight, number one, these chart lists, make sure everybody's aware of it, because if you're not getting these chart lists or you're not looking at them, I think you're doing yourself a disservice, especially if you're a short-term trader and you like to look at earnings reports and trade off of earnings.
We got a few questions.
Okay.
Do me a favor just before, because I'd mentioned before, this is kind of a unique period over the next week. Between tomorrow, Wednesday, and Monday of next week, we have 3 subscriber-only webinars. That's very unusual. Those are available to trial members. So can you pull up just a trial sign-up form? You can go right to our site at EarningsBeats, take out a free trial, and you get access to 3 member-only events. I can't remember that happening, Tom, where you had 3 of them within a week.
Yeah, and you get the full 30 days. So, I mean, you're going to obviously see a lot more between now and the end of your 30-day trial. And it'll give you a good sense of, what we do and whether or not what we do is a good fit for your own personal trading strategies. But yeah, we've got a lot of good stuff that we're going to be announcing soon. In addition to these webinars this week, they're already on the website. And the other thing, if you want to, you can go in, anybody can go in and look at our event calendar. And you can see, I mean, we do so many of these events. Of course, right now we have the Trading Places Live, and we try to update each month as we get into some big months. But you can see, there's another sneak preview in November that'll be for our model aggressive and income portfolios for our stock portfolios. Very similar to what we just did recently with our model ETF portfolio, the sneak preview.
Yeah.
But anyway, I just want to make sure everybody's aware that's how you can get to our
Yep.
event calendar. I mean, you can go back and scroll, but usually it's the first 2 months in each calendar quarter when we do a lot of events, because there's just so many things around the earnings season and also around the portfolios that we do. So that's when you're going to see most of our events line up.
Somebody wondered if you could do a quickie on Tesla. They report this week.
Yeah, that's another big one. Yeah, I should have pulled that one up. I wasn't really thinking, but let me see if I can pull up Tesla. I think, is that Wednesday after the bell?
Yeah, I think it's Wednesday.
So, all right, so that's Tuesday. Let me pull up Wednesday. Yeah, it would be the next one. There it is. All right, so we'll take a quick look at Tesla. Tesla, you can see right here, actually down at a pretty good support area. AD line, I mean, I'm not really liking the fact that we're back down close to 11-month low on the AD line. I mean, all the way through about March, Tesla continued to have very, very strong AD lines. They've come out, they've warned a little bit about deliveries recently. Stock's just been okay. Autos, not good. Autos have actually gone down and taken out the low that we saw back in May and June. And on a relative basis, they're barely holding on to that May low, which I would keep an eye on. Tesla, relative to the S&P 500, I mean, you can see Tesla relative to autos has been very strong. So if you're wondering about how some of the other autos are going to report, keep an eye on Tesla, because if Tesla can't beat, I think that probably bodes poorly for many of the other stocks within the group. So I don't know. It might be unless it's a long-term position in Tesla. If it's a trading position, I'd be careful heading into earnings with Tesla, this week, especially if we get any kind of rally over the next couple of days. I know we had a pretty decent day today on Tesla.
Somebody's more in general, if you have any, based on the price action in the last 2 or 3 days, any conclusions you might draw?
On Tesla?
No, in general.
Oh,
market.
Well, I mean, it's, bottoms are a process. Sometimes you get a V bottom. I really thought we might have that V bottom back in June. I mean, if you look back at history, a lot of the prior cyclical bear markets, when we've had these moves up to the upside like this, normally we don't go back down to this June low. So this is definitely surprise. It wasn't what I was expecting. I did not think we would go down that far. I think I had talked about when Fed Chief Powell came out from Jackson Hole with that speech about more pain ahead, whatever. I think at that point I was thinking 3,900 to 4,000. So when we got down to 3,900 and we started to turn up, that gap down and that move right there was a CPI report. And then just recently we saw again the CPI report and the gap down. But this time we're oversold. Last time the CPI report came out after a big move up. So we were primed potentially to move back down. This time was a little different. We came out after we had already been going down for 5 or 6 days. We got that gap down. I think we're poised to go higher. We've got positive divergences. We got max pain, all pointing to higher prices. It doesn't guarantee us that we're going higher, but I wouldn't be surprised to see us make a move for 3,900. And then we'll see what happens, because that was a big, that's been a big support level. And it's also been a big resistance level over the past 4 or 5 months. So 3,900, and then look at the 50-day coming down, getting close to 3,900 as well. So that if we could get up there, and we've seen big moves that happen pretty rapidly, and with options expiring this week, I would not rule it out, because there is a lot of in the money put premium. We'll see, but first test, get through the 20-day. I think if we get through the 20-day, then we have a shot to get up to 3,900.
Okay, why don't we wrap up? I don't know, actually, I'd have to look it up, but somebody was asking about Dick's Sporting Goods. If you had any thoughts on that one, we could wrap it up.
Yeah, let me pull that up on a relative basis. All right, so here we got the stock going up for the last few months. That's good in this market environment. AD line looks good. You look at the specialty retailers, which have not been very good on an absolute basis, starting to show a little strength on a relative basis. But look at Dick's. I mean, I think this is a solid relative strength winner. So yeah, I mean, I like this as far as trading. You know, if the market were to strengthen, here's one of your leaders already. So this would be the type of stock that I would want to have on a watch list. The fact that it's at the 50-day moving average, you got recent lows down around 100 to maybe this 102, 103 area. I mean, I could be building a position in Dick's from 110 down to about 102, 103, and then keep a stop. If you go below 100, you get out. But that would be a possible strategy for me. But I do like the relative strength here, and that's what I look for. When I'm trading individual stocks, I look for relative strength. I do not like to trade stocks that are underperforming their peers, because a lot of times it's just it's a warning waiting to happen. So you got to be really careful with that.
All right.
One thing I have said to members, though, is right now I'm really laying low in terms of trading individual stocks, just because of all this volatility. I'm still going to make good money if it goes up and I'm in the ETFs, you know, QQQ, something like that. With Max Payne, you could potentially do like the QLD or do a mixture. If I do any of the QLD, I'll probably stay mostly in the QQQ with a little bit of the QLD, just to kind of juice up my return a little bit. That's a possibility, but again, that comes down to each individual. And if you're not aware of the QLD, that is an ETF that tracks the NASDAQ 100 at a 2-to-1 clip instead of a 1-to-1 clip. And if you really want to juice it up, you could do the TQQQ, which is 3 times. So if the NASDAQ goes up 4%, your TQQQ in theory would go up 12%. But just remember, they go the other way as well.
Yeah, I want to just mention to people who maybe are on the fence about, sign up for the free trial. Number one, you get 3 events over the next, really tomorrow, over the next 6 days. And next week, when this is a sneak preview, we're going to have some companies that have reported, and then a ton of companies getting ready to report that, Tom will be examining some others. So I think, if you like today, you're really going to like next week, because earnings season will start kicking into high gear next week. So with that in mind, Tom, I think we're about ready to wrap up.
Yeah. I mean, next week when we go through these earnings, we're going to be taking a look at some of the ones I talked about today, just to see how they came out. We try to make this an educational process so that you can really start to get a feel for how it is that you might want to trade going into earnings season. So we will definitely take a look back next week at what we've talked about tonight, some of the individual stocks we talked about tonight, just to see how they reported, what the reactions were, and which ones we got right, which ones we didn't. And just to show you, I can promise you we're not going to get them all right. So this is no guarantee, but I do think relative strength is a really important part of determining whether or not you should take the chance of holding stocks into earnings or not. But that's it. Appreciate you tuning in. Tomorrow will be the Max Payne event. That's one of my favorites of the month. I know that's one of yours as well, John. And we'll be talking a lot about how much net in the money put premium is still out there on these stocks. So anyhow, everybody have a great evening. We'll be back tomorrow with our next webinar, and tomorrow morning with my next Trading Places live show as well. Happy trading, everybody.